Good afternoon, all. Welcome to today's Market Matters webinar, where we're going to take a look at interesting stocks as interest rates come down. We've obviously had a oversized 50 basis point or 0.5% reduction in US interest rates recently. So we're going to look at how that impacts the ASX, how it impacts our positioning around stocks. And I'm thrilled to have so many of you on the line. So my name's James Gerrish. I am the lead portfolio manager at Market Matters. I am joined today on the line by Shawn Hickman, who is the Market Matters research lead, who heads up our research function at Market Matters. You'll be able to unmute yourself and say hi, Shawn.
Good morning, everyone. Oh, sorry, afternoon, everyone.
Absolutely. I'm just going to...
Can you hear me there, Shawn?
Yes, I can.
Yep, great. Okay, all is going well. I'm just going to run through a quick overview of what we're going to cover today. Before I do, just a quick background of Shawn and I. So I've been in markets for over 20 years, managing portfolios involved. We've been running Market Matters for over 10 years now. It's a service designed to level the playing field in the markets. We often phrase it like that, but that's actually what we try and do. So we operate on the trading desk each and every day, write about our experiences in the market, how we're positioning our portfolios, and sort of try and bring our subscribers along for that ride. We're a clear, transparent service that tells it as it is, honest, transparent, and we like to say, we are a group of experienced investors, and Shawn certainly fits that bill as well, operating in the markets for over 30 years, proprietary trading positions in some of the large investment banks, etc. So really well experienced, and that's what we try and get across to our members on a daily basis. Before I begin, just a quick disclaimer that any advice provided today is of a general nature only, so you should consult your financial professional before taking any information on board. Again, it's general information only. This is just a quick slide that gives you a rundown of our investment process. We generally put this up in our webinars. We describe ourselves as a top-down meets bottom-up investment manager. So we look at what's playing out from an economic standpoint. The macroeconomic environment we think is really key, particularly when investing in large cap portfolios and actively managing large cap portfolios. We think there's economic circumstances that are supportive for some areas of the market, and we want to be positioned towards those areas at any particular time, and not in those areas where they've got headwinds from a macroeconomic standpoint. We look at sectors and our positioning, and then dig into the underlying stock selection. We use a range of quantitative and fundamental analysis to pick the right stocks to own at a particular time. That's pretty much from a bigger picture standpoint. Today we're going to focus on 3 key areas. So interest rates coming down. We think that's going to be a positive for global growth expectations, and that is going to be a positive for resources. We probably didn't, when we were putting this ideas together, Shawn, we didn't think that resources would rip so hard in the last 48 hours or so, which they have done following the PBOC, the People's Bank of China, releasing some pretty significant stimulus measures. So we're going to touch on resources, our view around that.
You're dropping it out, James.
Yeah, I've just got my headset's all right. I think that should be right. How are we going there? Shawn, you got me?
I've got you.
All right. Okay, great. We're going to look at some how lower rates will impact our view around property stocks, and the property stocks we like. We own some property stocks, so we'll run you through our best ideas in the space there. And then retail. So consumer discretionary has obviously been an area that has polarized investors over the last little while, but it's actually done phenomenally well. So we're going to think about our positioning and outline what stocks we own and how we feel about this area of the market at this point in time, given we are likely to go down the path of interest rate cuts. All right, we'll crack straight into it. We're going to show an overview of the Market Matters website, and we're going to dig through the site and explain some of our positioning and our approach to the market via the Market Matters website. So I'm going to share my screen and then get on with it in terms of that, Shawn. So you all should be able to see my screen there. I'll just go back to the home page. So this is the front page of the Market Matters website. So when you log in, you'll come and look at the front page of the Market Matters website. I don't want to touch on too much around how to use the website, etc., because we want to dig into our views. And one of the first views, Shawn, is around what's been playing out in interest rates. Obviously, the US Federal Reserve cut interest rates by 50 basis points. That's had a pretty meaningful impact on markets. Take us through your views around interest rates. Shawn's very, very good on the macro side of things.
We've been looking for the US to cut interest rates for a long time. Primarily, the bond yields lead interest rates. If you can get me up the 2-year bonds in the US, not the 3-year, James, that'd be great. But what we also have to balance is expectations versus what's actually happened. So at the moment, we've been calling US 2 years down to this 3.5% area for the last year, fundamentally, and they're here now. And this is really important. We feel that in the US market, the 8 or 9 or 8 further rate cuts that are factored into the market over the next 12 months might actually be almost as good as it gets from the US perspective. So there's two sides of things. US is going to have a great tailwind from interest rate cuts. If they get any more than those 8 or 9, the likelihood is we'll actually have the big R word raise its head again, recession, and that won't be good for stocks. So we got to balance those things in. So look, we got there 8.13 rate cuts by 2026, but fundamentally 8 rate cuts are priced in all the way through the middle of next year to the middle of next year. Perfect. Thanks, James. And then they're looking for a plateau. In other words, what they're saying, they're going to cut interest rates. Inflation is stabilized in the US. Unemployment is a bit of a worry. The economy is undoubtedly slowing down. They're getting ahead of the curve. They've cut rates by 0.5%. I think that all made sense. And their path is mapped out, and yes, things go offline. And that's great for stocks. It's a great tailwind for stocks because the companies that can utilize those lower interest rates, they should have a very good year. There'll be ups and downs. There'll be volatility, as we discussed a few times, about what will happen if we get the R word again. Sorry to keep saying that R word. We get rid of it very soon. But to me, the more interesting scenario is playing out now in the Australian market, because we haven't had the rate cuts. Michelle Bullock is balancing. The CPI this week came in below or into the target band of the RBA for the first time in a few years. But they don't believe it will stay there. They're concerned about the money that the government's pumping into the economy. I read in the Fin Review today the energy bill next year, when we lose our stimulus, will be 47% higher. So in other words, it's all well and good to put some short-term buffers in, but when we get back to reality, inflation is likely to kick back up. And that's why the market is only looking for 4 or 5 rate cuts locally. We think that will play out. It's 50-50 whether we get one at Christmas. But I think our market is a bit like the US popped after they got their first pivot or their first rate cut. And I think we can see that locally. So to me, that tailwind, we all know it's coming, or we all hope it's coming. But when it does, I feel that our market will also follow the US and get a bit more excited, for one of a better way of putting it.
Yeah, I think there's a couple of things to play here. So one of the interesting things, and the PBOC, the People's Bank of China, addressed this issue this week, is around liquidity and how that impacts asset prices. So when you cut interest rates, and we do focus on this a little bit because I think it's really important at the moment, when you cut interest rates, you increase the liquidity in the system, puts more money in people's pockets, gives more firepower to spend. So interest rates are one thing, they increase liquidity, but so do other measures. So remember coming out of the GFC when they launched quantitative easing, that was all about giving increased liquidity into the system. Coming out of COVID, when they sent checks and did all other different types of fiscal policy measures, but also cut interest rates aggressively, that increased liquidity. So all of these things are designed to increase liquidity in the system, and all things being equal, increased liquidity is positive for asset prices. So obviously the market has run hot. We're sitting here talking on a pretty good day for markets. The ASX 200 is at all-time highs, testing 8,200. So things are moving, but I think, in our view, I think if you're in the right stocks and the right sectors, there's still plenty of upside. I want to delve straight in now to underlying stocks, and I want to start by looking at our growth portfolio and going from there, because our growth portfolio has actually underperformed in the past 12 months. So one of the things you get at Market Matters is a true reflection of how portfolios are going, a true reflection in real time around how our calls are going and whether we're getting it right or wrong. So we've had strong outperformance across the suite of our portfolios since inception. In the last 12 months, we've had a bigger overweight tilt to resources. So we've underperformed over that time period by about 4.5%. What I will say is that there's been a marked, we all know in the last few days, there's been a huge shift back in the resources. And looking at the numbers just before jumping on this webinar, the portfolio is up about 4.5% for the month, which is about 3% ahead of benchmark. So that underperformance is well and truly being addressed. But one of the other things is around sticking to your conviction. So we've got a high conviction view around resources at the moment, and we show this through our portfolio. So in resources and energy, we've got a portfolio tilt to 35%. So 35% of our active growth portfolio is in resources and energy. That's compared to the index at about 24%. So that's a reasonable overweight tilt. I want to jump into specific stock calls on resources at the moment. I'd probably best to start.
Can I add one thing there, James, as well, is that we're overweight, but the market is very, very underweight the energy and resources. The lowest by about 7%. The lowest exposure was shown in the recent Bank of America Fund Manager Survey in many, many years. Hence the squeeze we've seen over the last few sessions.
That's a really interesting point. So positioning is really key, and we often write about positioning in our reports. So when the collective is overly bullish a particular stock or sector or area of the market, we think that creates risks. When area the fund managers traditionally are underweight an area, they're bearish a sector, when everyone's negative, and we've seen this recently in iron ore, yet iron ore stocks have bounced pretty aggressively in the last couple of days. We think that also we think that creates an opportunity, if you like. So positioning is really important in terms of the market. There's not a lot to add around BHP. I mean, it's the biggest index weight in the resources space here locally. Shawn, have you got any? We've recently added to our position sub $40. Anything additional to say around that?
Oh, I would. I think there's a couple of very quick points there. At Market Matters, we tend to flag what we're looking to do. We've been talking for a long, long time, many, many months, that we wanted to add to our BHP position around $40. We were patient. It got there. Doesn't always work out that well, but it has. And you've got to press the button as long as the reasons that you're looking to do that haven't moved. And the important thing with BHP, Rio, and Fortescue is that the major analysts are valuing these stocks at iron ore around $82. It hit 99 yesterday.
One of the things you can see on the Market Matters website is around what consensus expectations are and how that feeds into earnings. So you're getting the expectation is earnings will be going lower in BHP. So if you're negative on commodity prices in the upcoming years, that's going to feed into lower earnings expectations, and you can clearly see that in this graph that you can go and do on the Market Matters website. So that's feeding in iron ore prices about $80 a ton. So if that doesn't play out, and we're knocking our head just below $100 today, plus we've had a huge round of Chinese stimulus that certainly, I think, turned the dial on our view around resources and where the prices go in the medium term, then you can create a fairly bullish case for BHP. On the Market Matters website, you can see what portfolios we have BHP, and there's Shawn talking about BHP. So we hold in our active income portfolio as well as our growth portfolio. You can click on the portfolio and go and see our positions in any portfolio, what they've done today, which I think is pretty important. The position, the weight, when we've bought it, all our prior actions, etc. in terms of BHP. The other one that we've banged on for a lot about, and we've held for quite a while, Shawn, copper space. I don't want to continue to harp on this because we do talk about copper a bit, but we like it. We think over the coming years, copper is going to be a place to invest in, and we should stick with it. Sandfire's our copper exposure in the active growth portfolio. I'm going to bring up a smaller one that I think is interesting as well, because Sandfire is at all-time highs. But view on Sandfire, buying it here or just holding it?
Holding it, James. I mean, we've been calling it up to $11 or $12, even when it was at $7. It gets up to 11 or 12, we will reduce our exposure more than likely. I like it. It's almost the only option until you start being a bit clever and looking at Evolution as 25% copper play. I think it's, Oz Minerals has gone very bullish copper. That hasn't changed. Sandfire is the best option to play it locally at the big end of town.
I think something that Shawn sort of didn't allude to is also the operational execution of Sandfire. If I go back 4 or 5 years, they always dropped the ball operationally. Whenever a quarterly update was coming out of Sandfire, you were always concerned about it. You were nervous about it. In the last 4 or 5 quarters, they've continually delivered operationally, and they're bringing on new production, significant new production at a time when copper prices, arguably the outlook for copper prices are strong, and there's a lot of appetite across the market for copper assets. BHP's obviously had a bid for Anglo, etc. So we continue to like copper. A smaller one in the space that I think we actually own this in our emerging companies portfolio, that for those who are interested in the more speculative end of the market, this is a smaller copper company, capped at around $200 million. It hasn't had the same upside that Sandfire has done in the last little while. All the normal caveats apply around smaller companies. So, but A1M, so that's AIC Mines, a really interesting copper company listed on the ASX that we own from around current prices. There's been a huge move in uranium stocks this past week, Shawn. Microsoft is going hard into nuclear. Take us through your views around Paladin and the rest of the space here.
Oh, Paladin's up another 6% today, so it's probably very well timed. It's been a very, very volatile space, and in my and Market Matters opinion, it will remain a very volatile space. But as we wrote about this morning, James, we believe Microsoft are on the ball. We believe that nuclear is a very important component of clean energy going forward. We must never underestimate how much energy is required for AI. If you believe AI is a thing for the future, then I think it's in the next 5 years, the increase in power required for AI is equivalent to all of the power used in Japan last year. It's just phenomenal how much power is required. One of the reasons we own AGL, et cetera, one of the reasons why stocks like NextTC and Goodman Group have had great times is that AI is really, really, in my opinion, our opinion, a very big thing. It's going to happen. It requires phenomenal amounts of energy because that's not as popular these days. It doesn't get talked about as much, but it needs a lot of energy. And Microsoft are going in the US in the main way. They've locked in 3 Mile Island in the US, which had the biggest biggest nuclear disaster in the US in history. And they've locked that in, and they want to have a commitment of power. And to me, that just shows you, it reaffirms my belief that this sector is going to have a great X number of years. And as long as you've got a bit of patience and happy to stay in there, I think they'll pay dividends. And whether the stocks like Paladin locally, who have kind of doubled up recently when they bought Fission, or whether you look at Camalco overseas, these are very good stocks to play the move. Just be prepared for volatility. They are going to be volatile.
So, yeah, a couple of things. Like the Microsoft deal shows, we talk about renewables, etc., but AI and all of that requires significant baseload power. So Microsoft has signed a 20-year deal to take 100% of the power being generated by 3 Mile, which is, that's an incredible deal, and it refocuses attention back on the role uranium will play in baseload, providing base load power. The other thing that uranium has, or building uranium reactors has pretty significant lead time. So that flows into the outlook for other sources of energy in the interim. So I know Whitehaven Coal is more in the met coal space now than thermal, but New Hope, which we also own, is more thermal orientated. But the key message there is, uranium is I wholeheartedly believe it is going to be a huge part of the global energy mix into the future. The other important thing is that it takes time to roll these out. So you've got, as we've been consistently writing about and saying, you've got this window where coal is going to be used for a lot longer than anyone thinks. Energy transition will take a lot longer than anyone thinks, and that's why we've stayed, bullish on the likes of Whitehaven Coal and New Hope, etc. Shawn made a good point about volatility. This has been a volatile area of the market, and you'll have times when it doesn't go against, it goes against you in your portfolio. But you've got to be thinking about the medium term themes, is what we do at Market Matters, and also construct a portfolio, Shawn, that has a mix of exposures in there. So it's not all about, we say we're big overweights, we've got about 35% in that space. We've got a lot of other interesting, some more defensive businesses, some that are tech orientated, and so on and so forth. So it's about constructing a portfolio, and we'll get on the property shortly, that gives you blended returns over time on a risk adjusted basis.
Exactly. You want to have the thematics playing out that you believe in. But if you're tossing a coin by being all in on one area, you will lose.
Yeah, we're down on our Paladin position at the moment. We re-entered at $15. We did make some really good money on our last position in Paladin. Sold it. I can't remember the numbers off the top of my head, but it was a 40 or 50% win in terms of Paladin. We've increased we've gone back into it at higher levels, and we saw a decent drawdown in that position. In terms of the other position that's on your screen there, you can see the gains and losses of all positions are shown in real time. So Mineral Resources has been a struggle for us. We've got this one wrong in the short term. We actually still like it. We think there's a really good, in 12 months time, we think this stock will be a lot higher than it is. Just to give you an idea about what Min does, obviously they're exposed to iron ore, they're exposed to lithium, and they've got a mining services division. Iron ore accounts for about 50% of revenues, the other two about 25 apiece. We often hear that Min is a very leveraged play in the space. When you think about that, it's obviously leveraged from a balance sheet point of view, so it's carrying too much debt, although that has been paid down somewhat this week. But they're also leveraged in their operating model. So they're a vertically integrated model whereby they're rolling out their iron ore mines, they're rolling out lithium productions, and they're underpinning that, or benefiting from that, with their mining services company that does the services to these divisions. So when you cut CapEx and you cut gross spend, you also undermine your earnings in your mining services division. So the operating model, if you like, is more leveraged as well. So if you're bullish on commodities as we are, then Mineral Resources are highly leveraged play in it. We think they will muddle through without needing to raise equity. And if that's the case, they won't be trading at 40. They were below 30 last week, or at the start of the month. So they've obviously had a good recovery, Shawn.
Yeah, I think you've also got to point out that this became the short of choice for the prop traders out there. They've decided that Chris Ellison might have to raise capital. If he has to raise capital, let's be short Mineral Resources rather than maybe Pilbara. Pilbara's been the largest short stock on the ASX for the last year and a half, I think now. So we saw a lot of shorts come into Mineral Resources because everyone thought iron ore was going down to who knows where, but below 80. People thought lithium stocks are going to be worse for longer, and that Mineral Resources would have to raise money. All of a sudden, they might not have to raise money. I don't think they will. Iron ore is nearer 100 than 80. And the shorts will be getting very, very nervous, if not starting to get out. And we've seen, with a bit of obviously fortuitous timing, that the stocks rallied very strongly. It was $80 only a few weeks ago, really.
Yeah. In terms of the lithium trade, so this brings another interesting point in. We've written recently the remedy for low prices is low prices themselves. So what we mean by that is that production, future capacity comes off stream when it's not incentivized to, from a pricing point of view. So everyone's losing money in lithium at the moment, given where prices are for spodumene. no one will bring new capacity on stream, and ultimately that will work through the system, and prices will correct. So one of the things I've learned over many years in dealing in commodities, is that don't get over optimistic on how far prices can rally, because ultimately new supply will come online if it's incentivized enough by higher prices. And the other side is true. Weak prices will certainly disincentivize new production, new supply coming on stream, and you'll get pounds, you'll get volumes pulled out of the market when prices are low. That pretty much wraps our view around commodities, but we're keen on the broader diversified commodity players. BHP still at 42. I know it's not a it's not an earth-shattering idea, but that's going to be a key beneficiary if we see an uptick in global growth, underpinned by fairly aggressive interest rate cuts or less restrictive policy in terms of interest rates. We continue to like uranium, we like coal, and we still like copper, although bearing in mind Sandfire has had a good run in the last week or so, Shawn. Now we're going to move on to property. Because we think this is an area that's also got a lot of upside on the back of interest rates coming down, Shawn. I'm just going to quickly run through our property holdings, and then we can chat on them after that. So in our active growth portfolio, we've got 3 holdings. We've got GPT, we've got Mirvac, MGR, and we've got National Storage REIT. To give you an idea, we've got a 13% weighting towards property. The index is just a shade below 7%, so we're overweight in the property space. The other companies we own in other portfolios are Centuria, CNI, and BWP Trust. So that's the Bunnings Warehouse Property Trust. So let's start perhaps with one of the ones we bought recently is Mirvac. We're not up a lot on the position, Shawn, but we like that one.
Yeah, I think Mirvac's a solid company. The whole space is fairly high yielding, which of course will benefit when Australia finally does cut rates to a greater or lesser degree. I think it's got $2.50 all over it. If we're just going to talk pure numbers, I think it looks very, very good. It's yielding about 4.8%. It's not franked, so I think it makes it a little bit easier to hold some of these stocks with a bit of patience when you're getting some yield out of them as well, James.
Yeah, I think just to give you some context around it, we had Goodman in the portfolio for much of last year. Over the past 12 months, that was our top performing stock. We have sold that around $36 before they reported their FY24 results. We simply think so. We in the property space has been a couple of areas. So these more boring property companies have been sort of kicked to the curb. They've been weak. I'd throw Dexus in there, GPT, and a bunch of others that haven't attracted much love. Goodman Group got all the love over the past 12 months, and their share price has been reflective of that. We sold Goodman because we think there's going to be a gap between the strategy they're rolling out in data centers, and we think it's a great strategy, but the gap between when that will actually have a meaningful impact on earnings. So that's the reason we sold Goodman. We may well go back into Goodman, but we use that higher priced sale, if you like, to start adding some of these less loved property companies, such as Mirvac. The other one I'd highlight there, Shawn, is National Storage REIT. We've held this for a little while. It's breaking out today. This looks phenomenal. I like this stock because it's a boring stock that's reasonably priced. It's got a reasonable yield. Plus, has got some really interesting thematics that I think should drive it over the years ahead.
Like you, I'm a huge fan of National Storage. If we're going to go into higher density living, which I believe we are, the long-term trend is storage will be more important for a lot of people. That is obviously what National Storage are all about. So I like their structural business model. It's making a good profit. It's paying a good yield. I see nothing I don't like about this stock, and I think it will be trading a lot higher. Might even get back up to the levels where people were trying to buy it, or the takeover bids came in before.
Yeah, absolutely. So this is a core portfolio holding in 2 of our portfolios, the income portfolio and the active growth portfolio. We continue to like it. We still think it's undervalued. It's trading still at a discount below its NTA. And they've done some interesting deals lately. They did an interesting one with QIC, etc., to improve their to grow their earnings, if you like, in different areas. So this is one we particularly like. The other one that's had a really good run recently, I think this is a more leverage play on the thematic around lower interest rates and lower mortgage rates and all of those things, and improved liquidity, is Centuria Capital. So Centuria Capital is held in two of our portfolios, the active income portfolio and the emerging companies portfolio. Just getting a chart on the screen there when it comes up. Just in the last couple of weeks, since this change around interest rate expectations, or they actually started cutting rates, it's had a meaningful impact on the shares of Centuria. Why? Because it's leveraged. So these guys they're obviously leveraged to fund flows coming onto their platform. When interest rates have been high, people haven't had available cash to put into property trusts and the like. Plus, they carry a reasonable amount of debt. So, and they made the decision not to really hedge a lot of their debt, although they have hedged more of it over time. But ultimately, it is a very leveraged play on the outlook for property. And we think the outlook for property is improved. So the outlook for Centuria has improved. And we're not the only ones. It's run from about $1.80 to about $2.15 in the space of 10 days or so.
Exactly. And I still think it's going to go further. It might have a bit of a rest. It might consolidate after such a dramatic move. But this is a stock in pullbacks. So I think we'd still be buying rather than selling into bips.
One of the interesting things that brokers have started changing their view around this stock. So there was a lot of negativity around Centuria for quite a long time. So we are starting to see a few more buys pop up. A couple of brokers upgraded their expectations of Centuria in the last couple of weeks. So we've gone from this universally bearish setting from analysts to incrementally more positive, and that's met a company that doesn't have a huge the liquidity in this stock isn't huge. It is a relatively large company. But it doesn't have a huge amount of liquidity in this stock, so it has moved pretty aggressively on the upside in terms of their share price. But it's one we like, and you can see from financials, etc. Dig into what the financial outlook is for Centuria in a bunch of the Market Matters data feeds, and then you can go back and look at all of the opinions over time that we've written about Centuria. So it goes back for a long period of time around what we've written about the stock, and then you can go back and see all of our actions. So what have we done on Centuria? What's been our view over time around Centuria? And then you can link back into the opinions that we've written there. So it's another way we ensure that our views are getting shown right across the site, relevant to each individual stock, and we go from there. We'll wrap that up on property, but
I'll just add one thing just to expand. When James says that Centuria's liquidity is quite low, it's only done about $1.2 million worth of turnover this morning. So if you're a fund manager that wants to allocate some funds into it after being underweight for a long time, hence you get the sort of moves we have seen over the last couple of weeks.
Yeah, absolutely. I can certainly attest to that. When trading Centuria, it takes a little while to enter and exit positions. So I guess that's something you need to be conscious of. But one of the benefits you do have when you're a smaller retail investor moving around in smaller amounts of money, rather than a large fundy moving large licks of money. Let's move on to the key takeaway in property. We're overweight the space. We've got about double the index weight in property in our active growth portfolio. We're comfortable with that weight, and we're going to continue to hold that. We like some of the lower, the cheaper property exposures than the more expensive ones at this point in time. But if Goodman was to pull back further around the $30 mark, we think that has a great runway, but we want the risk reward to be better than it is right now. Retail. Let's jump on the retail, Shawn, because we've got this in here. Retail would be a key beneficiary of lower rates you would expect. Yet in our growth portfolio, we don't have any retail stocks.
We don't, but we did. we quite recently took profit there. If you just go down a bit more, James, we quite recently took profit on JB Hi-Fi, a nice profit over 30%. In hindsight, we got out after its result. It got up to our target, which is around $75, $76. It has pushed a bit higher since then. So in hindsight, we got out too early, but we've utilized the money elsewhere, which is always a good thing. But again, this is a quality operator. It's trading in our opinion, we wrote about it this morning, it's trading on the rich side, which is understandable. You know, I repeat myself, this is a quality business, but I don't see at the moment the reason to chase it above $80. But any pullbacks, and we still will be, you know, reassessing where we want to re-enter as opposed to if we want to re-enter.
So we did write about it this morning, and we have updated our opinion, you know, liking it back around that near that $70 mark. I think one of the interesting things, you've got to be prepared to sell things too early, buy things too early, etc. You're never going to get it right to the T. Our thesis on JB was around the market's under appreciation of their earnings. So we thought going into the result, we've owned it. We owned it. So from the we owned it for about 6 months, I think, Shawn, from memory.
We bought it in May. We bought it around May when the whole sector was thrown in the bin.
Yeah, so we're talking a 3-month hold.
Yeah, exactly. When the whole retail sector was thrown out, we simply picked what we thought was the highest quality operator along, you know, that or Super Retail at the time were our favorite 2 picks.
Yeah, we've got Super Retail still in our active growth portfolio, our active income portfolio. We've still held on to that one. So, in terms of the market's under appreciation of a quality retailer and them being too bearish on their earnings expectations, which has played out. The other company that fitted that bill going into earnings was Car Group. We still think that's the case with Car Group, although it has had a reasonable run in the last little while. The other interesting, so retailers, discretionary retailers, obviously they're net beneficiary of lower rates. We get that. But they've preempted a lot of these things. So we looked at JB Hi-Fi that's had a really phenomenal run, is now trading at $80 odd. It's trading on a multiple that's circa 20% above its normal multiples, trading on 19 times. So there is now a fair bit of optimism baked into the JB Hi-Fi cake. The same could be said for Super Retail. So we still own Super Retail in our active income portfolio. $18. The reason we own this, it's a little bit more diversified. So they've got a number of different brands targeting a number of different consumer segments. They've also got more capital on their balance sheet, so they've got a higher propensity to pay special dividends, which they did at their recent results. So Super Retail, it's sitting in our active growth portfolio. We're currently up a fair way on this position. I don't think we'd be a buyer here, but we would be a buyer into any weakness in Super Retail, which we'll keep a handle on. And we would update subscribers around when the risk reward looks good for Super Retail.
Exactly, around $18. I think the next 5% is still probably on the upside. It looks really, really good. It's doing everything right. But as you say, the risk reward around here is a bit more balanced.
One stock that we wrote about this morning was AP Eagers, or Eagers it's called now, not AP Eagers anymore. So Eagers is a largest car yard in the country. It's been under a lot of pressure in the last 12 months or so. So obviously there has been some weakness in car sales over the past 12 months. There's been weakness in the level of EVs that have been sold. They got their inventory levels wrong. So they've really been sold down. We flagged this from a macro perspective this morning, Shawn, around what could happen if liquidity increases.
Exactly. And I think importantly, we think it's a case of when liquidity increases. So one of the reasons we put the stock in today is we've recently put it on our hit list in the income portfolio. I know that from talking to a lot of subscribers, they do tend to like to buy stocks when they think they're cheap. And this is a company which we think is really starting to show some value. And when that dial does turn on liquidity, when they start to chew through that excess inventory, probably be too late when that excess inventory is gone. Yeah. The stock will come back up. So risk reward, I'd most certainly put it in the accumulation area right here, right now. Maybe you'd leave a bit of room if it has another dip on the downside, but I think it's looking good now. And again, virtually every other stock you mentioned, I think it was JB Hi-Fi trading circa 20 times above previous valuations. Well, APE is the opposite. It's trading cheap.
Yeah. So yeah, JB at 20 times FY25 earnings. APE is trading on 11 times. It generally trades circa 15 times. So the market, the reason why we often talk about this relative valuations, it shows how the market's positioned towards a stock. It shows how optimistic or under or negative they are a particular stock. So there's a whole bunch of reasons what should dictate the earnings multiple you pay for a company and how that can change over time. So you can't just use an earnings multiple relative to history to see whether or not to buy or sell a stock, but it is one of the inputs that we use. So these stocks are relatively cheap. So APE is relatively cheap at the moment. Is there a catalyst to turn that around? Is there a catalyst to see their earnings improve? And then as to get outsized gains from the share price because you get an improvement in earnings and you get an expansion of the multiple. And that's really when you get, that's what really drives stock prices over time, is if you can combine the two, earnings growth and expansion in multiples. The other important thing, so we know EVs are coming, we know they're going to sell, we know the rollout is going to happen. We're all, every other person's going to have an EV over time. That's going to be bullish for AP EGAs. Like the lithium trade, the market got very optimistic on what that would mean for them in the short term. Hasn't played out in the short term. And the other thing that I'd say about EGAs is they have, this is going from memory, they have about $800 million worth of property on their balance sheet. So that's going to be of benefit to them as as rates come down and valuations of those properties go up. So on 10, 11 times, yielding 7%, we're trying to find a catalyst in the near term to see it re-rate. But I think it's one that's certainly on our hit list and one that we would likely buy for income in the not too distant future. Shawn, I'm going to wrap it up with just a couple of comments. So interest rates are coming down. We all know that. They went super hard in the US, down 50 basis points. They may go another 50 basis points at the next cut, but ultimately interest rates are coming down. Our interest rates are still restrictive. So at 4.35%, that is still restrictive. I would say that we are seeing weakness from a growth perspective. We're seeing easing in the labor market. We're seeing wage growth start to come back, and we've just got inflation. I know it was a monthly read, but inflation's come back into the target range, and the trend of inflation is going in the right direction. Don't forget, in 2022, inflation peaked at 8.4%. We're now at 2.7%. So there's been a huge amount of positive developments around inflation. Whether the RBA cut before Christmas or in 25, I think that's pretty irrelevant. Rates are going to come down, and there are going to be implications for the ASX. And the three sectors we've spoken about today, they're three areas that we like. We're overweight resources, we're overweight property. We like consumer discretionary retailers, but they've run hard in the short term. So that's pretty much sums up our views around that. We've probably got time for a few questions, and I know there's a few come through on the pipeline. Have you got anything to add just there from a bigger picture standpoint?
No, I think importantly, rates are going to come down. I totally echo your comment. It doesn't matter if it's December. It doesn't matter if it's early next year. They're coming down. You got an election next year. The government would love them to come down beforehand. Michelle Bullock is doing her job and she's focusing on inflation. But at the end of the day, rates are going to come lower, and these stocks and these sectors will benefit.
I don't know. She's had a lot of noise at it, Michelle Bullock. It's pretty unprecedented, the fact that the government is trying to interfere into an independent RBA. There's a lot of advice going through Michelle. It's phenomenal what we're hearing, I think. Okay, so we've got a few questions. The first one is on APA and lithium stocks too. So APA Group on the screen there. We own APA Group in our income portfolio. We're down on the position. We think it's one of the most compelling income stocks to buy in the market at the moment. Over time, it generally trades at about 2% spread to the risk-free rate. It's now up 3 to 4 times, 3 to 4% above the risk-free rate, and that gets even better if the risk-free rate comes down. So I like APA here. I reckon it's my number one income pick. Shawn, anything to add there?
Yeah, I even think it's a candidate for the growth portfolio if we decide to get very defensive.
Yeah, I mean, we'll debate that another time.
There's a big if there. There's a big if there. But sometimes, at the end of the day, to me, a growth. I know we often disagree, but I don't think subscribers would mind that. But I think if a stock's going to go up, then it's got growth. And the bottom line is that if we decide to go very defensive, APA has got logic behind it.
Yep, absolutely. I do get that. I think we get too caught up on the, the textbook definition of growth versus income and whatnot. At the end of the day, we're investing for growth in share prices ultimately, and however that growth comes is what we're after. And the other one was about lithium. So whether or not lithium's going to turn, I know it's turned a bit in the short term. Here's Pilbara on the screen there. What's your overarching view around lithium at the moment? We've obviously got just mineral resources, and we've got a small position in Liontown, our emerging companies portfolio.
After watching the likes of Pilbara pop 30% already, I'd have to, when I say already, I'd say over recent weeks, I'd have to be a bit cautious here to see what comes next. Just as I'm very, very confident that the copper price will look good in a few years' time, the copper miners should look good. I hate to be boring and repeat myself there. Lithium is a chemical process more than a mining process. The lower prices haven't yet seen as much closures and lack of supply coming on. So I'm a bit more cautious how hard they can run before they hit a brick wall, because I think it's very important that people understand that one of the reasons we like the likes of BHP is that the big miners are priced with iron ore at 80. Today it's on 100. The opposite is the case with some of these lithium stocks. They're priced for higher prices for lithium. People haven't necessarily swallowed the bullet there, and subsequently they're going to be capped on the upside, in my opinion.
Yep, agree. Question on Helios. Helia. So Martin's asking about Helia, not Helios. So we actually we just bought Helios recently in our active growth portfolio. I think there's a big turnaround likely at Helios, but HLI, we have this on our income portfolio hit list. This is the old Genworth mortgage insurer. And we've got here that we like it around the 370 mark. So yes, we do. We think the big movement that played out in Helia over the past couple of months was that the notification at CBA was going to put their LMI business up for tender. Helia has the majority of CBA's LMI business, lenders mortgage insurance business, but they're going to put the lot up for tender. The likelihood is that Helia will win that. But I don't think the risk reward stacks up right here. I think because we've got that uncertainty, and I don't know this, I forget the time frame off the top of my head around when that tender is going to happen. But I don't think it's in months, so or into 2025. So I don't think there's any reason to jump on Helia right at this point. I'd get interested again around 370. But I do. It's got excess capital on their balance sheet. When the demand for LMI is low because there's not a lot of people buying high LVR homes, then they struggle with the top line growth, but then they release capital off their balance sheet, which is a positive for shareholders. So there's some offsets around Helia. We like it. It's a fairly complicated business. I hope I haven't complicated that too much, Shawn, but it is a bit of a complicated business.
Yep, I'm not going to add to that, James. I'll leave that.
Macquarie drop in rates was a question there, Shawn. So I take it, is Macquarie going to benefit from a drop in rates?
Well, we wrote about that this morning. We think the answer is yes. One of the comments we used in the morning report, which I really thought was interesting, was nobody is talking about when do we buy the banks, when do we buy a pullback in the banks. Every single week, in fact, almost every day when we speak to people, they're saying, well, should we sell the banks? Should we sell the banks? And obviously, it's been a bit of a wealth destruction mode selling banks this year. Macquarie is a company we think will benefit from lower rates, and any pullback in Macquarie, we're likely to be potentially putting our hand up and adding to our banking exposure via this leverage play.
Yeah, we were talking about it yesterday, and the thing about, and I spoke to it at the start of this webinar around liquidity and activity. So lower rates will increase the level of liquidity in the system, and it'll also increase the level of activity in the system. And that has lower rates pumps up asset prices. So all things being equal. So one thing that is the lifeblood of Macquarie earnings is activity. liquidity, if you like, and also asset prices. So, yeah, I think it all looks good, pretty good for Macquarie if the in the environment that we're going into. So they've obviously got their challenges and whatnot, like every company does, but I think they've shown historically that they can manage those pretty well. So we like Macquarie. We wrote this morning that we'd be interested in them below $220 a share. Helios HLS from Tim. Yes, we just bought Helios. So I know not a lot of analysts like it. There's been a few begrudging upgrades to the stock in the last week. They got a really good price for Loomis, their imaging business, over 900 million, about 800 million will flow back to Helios on that. That will totally address their balance sheet, and they'll have other means to do capital management and refocus their business on what really matters to them. So it's been a pretty average last several years for Helios. They really cocked up the benefits of COVID, but now they are getting their house back in order and their balance sheet is in good shape following this sale that happened at a better price. So I like Helios here.
Yep, the same. I got the wrath of a couple of investors when Market Matters invest. They weren't very happy when we bought it. But it's, I think it is a great growth potential, a great turnaround story, and there is a time and a place to have turnaround stories in a portfolio, and I think this is one that fits very, very well.
Yep. Richard is asking, is it too late to buy gold stocks?
My personal view, from a risk reward point of view, yes. In this leg higher, do I think you'll get another opportunity in the next 6 months? Yes. Be patient. Longer term, we like gold stocks, but right here, right now, it's a bit 50-50. We trimmed our evolution recently. I feel like that was the right move.
Yep. The hardest thing in markets is not following the crowd. So I know everyone is super bullish on gold, and every time I open a website, there's articles from a lot of I was about to say spruikers, but that's probably a little bit disingenuous. But ultimately, everyone's saying buy gold, buy gold, buy gold. I get it, but when everyone's saying that, I think it's not the time to go in and after these stocks have run so hard, it's not the time to chase that strength. Something will happen that will improve the risk reward in these stocks. The US dollar is back down at the bottom of its range. There's a huge number of interest rate cuts already priced into the US market. We trimmed it because we think it's almost as good as it gets for gold. Weakness in US dollar, a big pullback in bond yields, so on and so forth. So we think it's as good as it gets for now, but we would go back there and buy it if it, the risk reward improved. In terms of timing, there's a few more questions there which we're not going to get to. We're going to wrap up this webinar now. We've gone just slightly over the 45 minutes, but I appreciate everyone on the line today. If you do want a bit more information about Market Matters, you can go and jump on the website, marketmatters.com.au. This is our logged in section. If you log out, you'll be able to go and see the website there, and you'll be able to get a bit more information on subscriptions if you're that way inclined. We appreciate you being on the line. We're a fair and transparent service, and I hope you've enjoyed today's content. Shawn, thanks for joining me today.
Pleasure as always, James.
See you guys.